You're in the Business Insurance Zone with me, Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. This week on The Biz, the monthly update series for July 2013, and on today's show, the Annuity Update with special guest and nationally recognized annuity expert, Eric Palmer.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial advisors right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, the millennial marketer himself, Eric Palmer. Hey, Eric.
Glad to be here.
Well, not only am I glad to have Eric here because Eric has been really pushing the envelope of bringing new contracts. And we talked about this contract last month from Genworth.
Right.
This is I would have to say, one of the most innovative contracts we've seen in the last 5 years, easy. And on top of that, oh my goodness, FINRA licensed registered reps who normally, as you know, don't like to sell index contracts,
right,
are looking at this because it has a flavor of potential that I think is above the line onto traditional index annuities. And so even though it sounds like we're almost like doing a commercial, it's so out there and avant-garde, I think we need to talk about it.
Well, you mentioned a couple interesting things. First, the FINRA guys, they typically don't want to sell fixed index annuities when they're built around those 10-year surrender charge chassis. And most of those 10-year chassis have surrender charges that are even greater than the 10% the first year. So their broker-dealers won't even let them sell them. It's really nice to see some good product. And we've been talking about the 7-year surrender charge, the 7-year index from Genworth, and that's already been getting attraction from those guys. But we just launched about 2 weeks ago the 5-year index annuity now from Genworth as well. So they've got a 5-year chassis and a 7-year chassis, both that have this new innovative Cap Max indexing strategy, which as we'll talk through here in a moment, you'll see it's got the highest potential for growth out of any of the index annuities we've seen today.
What I'm looking for in an index is always looking for that upside potential. This index is way different in this roll-up provision, which I want Eric to explain, and I want us to take some time on it because I think it's worth listening to, and you may say, this is exactly what I'm looking for. I really don't want to go into variable annuities.
Right.
I really don't want to be into ETFs and mutual funds, but I don't know if I'm really in love with the annuity market, especially caps and participation rates being so low.
Right.
This kind of gives you the best of both worlds. It's not a security still, but I think a lot of our FINRA reps are looking at this, and when they start looking at it, I think our regular producers should.
Absolutely. Well, this is a product that really allows you to start addressing the accumulation side of the marketplace. Now, we've been so focused over the last several years on the income riders because, let's face it, when the Treasury's less than 1% or just over 1.5%, it's fluctuating all the time. The interest rate environment's so low, our story really became focused on the income, creating that paycheck for somebody in retirement. But there's still this massive population out there of people looking for accumulation. And they're becoming less and less interested in the market. We just saw last week, and we've got a market summary that we can provide everybody that watches the show, but just last week, the S&P is still climbing, so does the 10-year Treasury, but then unemployment goes up, and we have all these factors and these variables that are inevitably pointing to the fact that we may be facing another cliff. So when you're looking for accumulation, people aren't so interested in being in that volatile place or the potential to lose, or that risky place to lose some of your money. So these 5 and these 7-year chassis that have the accumulation capability is really where it's at, and there's a huge market for it.
So if I have a good year, let's say 2013, I have a 7 to 8% return on the SPI. Actually, it's a little higher than that now.
Right.
So let's say I have that. But in this provision, I can either keep it or I can
let it roll. Right.
Now, what does that mean, let it roll?
Well, let's think about this. First, what we're doing is we're giving you the opportunity to accumulate at a higher rate possible. So most index annuities today have caps, annual caps of somewhere around 3, maybe 4%. So that in that given year, you would be stuck with taking that 3 or 4%, which is not a bad rate of return. But if you're looking for something more, Genworth's Cap Max, the Cap Max strategy, gives you the opportunity to take the rate of return in that first year and roll it up to the next year. And in fact, you can do that for 3 straight years. And over that period of time, there's a little a calculation involved to allow you to achieve a higher rate of return across the board in every given 3-year segment of time. Now, why is that important? When we look back over the course of 7 years, we'll see that there's actually the probability over 70% of the S&P to have 3 straight years in a row that could have good solid returns. And even if we see a couple of years, going down, that means we even have a higher probability in our accumulation period to see those 3 years in a row. So off of that, what Genworth has done is they've given you the opportunity to roll that interest over, take a gamble on the fact that you might get another year of strong returns, and they're going to give you a multiplier to take that rate of return and triple it over the course of that 3-year period of time. So let me give you an example, because it sounds kind of confusing when you speak about it out loud. Let's take the 5-year new product from Genworth here, using the Cap Max strategy. Now, in the high band, which is over $250,000 of single premium, you've got an annual cap of 3.7% on the S&P. Okay, so let's assume you had that example you just gave where the S&P was up 7%. So we passed the full cap of 3.7% through. So what we're going to do is we're going to decide we're going to roll that to next year. So in year 1, we're going to take a 0, and we're going to roll the 3.7 over into year 2. Okay. Now in year 2, let's assume that we have that opportunity again to hit that full cap. We capped out again. So here's how this math works. They're going to take 3.7% and they're going to multiply it by 3, which is going to give you 11.1%. Okay? So going into year 3, you're going to take away another 3.7% for your cap, and you're going to roll it over, right? And let's say again in the 3rd year you got another rate of return that was higher than the cap. So we had 11.1, we rolled 3.7 over again, and it maxed out. They're going to take that full number and they're going to multiply it again by 3. So what happens is your 7.4 plus your new 11.1 is now an 18.5% rate of return in that 3rd year. So you took the chance, you gambled, you didn't take 3.7 in the 1st year, and by rolling it for 3 straight years, you took a total of 18.5%.
Now we still have the underneath protection of an index, right? You're not
Absolutely, you
losing
have the
anything.
floor.
You're
You
not
have the
losing-
floor of the index.
What you're gambling is your earnings that you had that year for a multiplying roll-up. A multiplier that will roll in your roll-up could actually be, you said, like 18.
18 and
in
a
a
half.
36-month period.
Right.
Wow. To me, that is a monster possibility, and that's why I'm saying, why, if I'm going to be in annuities for a long haul, why wouldn't I look at this? When we come back from the break, we're going to continue our annuity update for July 2013 with Eric Palmer. And don't forget to enroll in IUL University for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Did you know the average 401k runs out of money just 7 to 8 years into retirement? Time Magazine, the Wall Street Journal, and many other publications have warned of the difficulty of saving with a 401k. But what if there was a way to create tax-free lifetime retirement income with no stock market risk? Good news, there is.
You know, living in fear of the next market dive is not the way I want to live my life.
Why would I go out there and take on risk when I don't need to?
I have a lot less stress knowing I can't lose any more of my retirement savings in the stock market.
Call now to receive your free, no-obligation analysis of what this retirement vehicle could do for you, a comparison to your current retirement plan, and a free video that explains this exciting opportunity. Start planning a retirement you can enjoy instead of worrying about future tax increases and stock market losses. Creating income that will last your entire life is the most important thing you'll ever do. Take control of your future. Call now for your free analysis, comparison, and video.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can order today's materials, and we have a lot. Just hop out to our site, thebiz.tv. And while you're out there, click on the Biz blog for the Backroom Technician 30-day free trial offer to access the best needs analysis and client educational materials that address almost every financial planning scenario. And of course, yours truly is one of the contributors to Backroom Technician. I've been using it for almost 23 years. I think that's before you were born, Eric.
Yeah.
And remember, just a heads up, before moving forward with any of the ideas on our show, always consult your tax advisor or legal counsel, especially if your broker-dealer compliance officer is going to want to know about it, and he does, if you're FINRA so licensed. Now, we're in the middle of our monthly annuity update, and I'm sorry that it sounds like a big to-do for Genworth, and I hope they're paying us for this because they're not, but I wish they were. But I wanted to go ahead and do something before because, you know, I'm a visual guy. I have to see it. I mean, I kind of heard what you said. I kind of understand the theology behind it, but I want to see it. So we put this up on our screen right now and kind of be able to walk through it. And just give us a quick walkthrough again, and then we'll get on to our rest of our
Sure,
stuff.
absolutely. Again, let's remember that if we have a 3.7% cap in the top bracket here for this index annuity, in year 1, let's assume we got a high enough rate of return that, again, we got that 3.7%. So I'm going to put a 3.7 in my 1-year column, but I decide to roll that to year 2. So let's carry that 3.7 over to the 2nd year, and in year 1, we're going to take a 0. okay? Now, in what's going to happen is we have a 3% multiplier on this. So we're going to multiply that 3.7 by 3. We got an 11.1 for year 2. Now, assuming again that we want to roll that over to year 3, we're going to take out the 3.7%. We're going to roll that 3.7 over to year 3, which drops our 11.1 in year 2 to a 7.4, okay? And let's assume again year 3, we hit the jackpot one more time. We got that rate of return out of the S&P. The cap's carried out at the 3.7. That's again multiplied by the 3. We've got an 11.1 for year 3 plus the 7.4 from year 2.
Yeah.
We've got 18.5 from rolling that interest for Athene. We've been discussing them for the last 12 months because they have this product called the Benefit 10. But something really amazing just came out with their product and their illustration software. Now, one of the things that you see here, probably on today's show, is there's a commercial for the iPad the iPad app that Athene came out with. And this app is really great because I've seen some insurance companies come out with apps. They're boring, or they really don't do much for you. They're sort of just a visual of a glossy brochure. But this one actually lets you run quotes. It actually helps you tell the story to the client about why the benefits are great. And remember, this has the long-term care benefits, this has the income and the death benefits. So this is an all-in-one rider.
And it's on iPad and on your smartphone?
On your smartphone, on your iPad, the Apple store has that available to download. And of course, you can get the link here from the Biz. But what's interesting, they just revamped their software. Now, one of the biggest stories we've been telling for years, and there's not very many products anymore that can even do this, is when you got qualified money and you get to that RMD stage, you're 70 and a half and you're forced to take these withdrawals, if you can get a guarantee of something greater than 4% compounded interest a year inside a fixed annuity, like an indexed annuity, for example, then even though you're taking those withdrawals every year, if the rate of return is added back in there, you have enough money to create that arbitrage that you actually won't eat away your principal. Now, the Benefit 10 has that capability. Because of the 8% simple interest that you get in the first 10 years, it actually gives you enough growth in certain age cohorts that you can use this product to take those RMDs, and the death benefit will have that guarantee to be offsetting those withdrawals. So let's say we take income for 10 straight years because of that RMD. At the end of that 10th year, I'm going to have more than my original principal than I started with, despite the withdrawals. Now that's a huge arbitrage move, and we actually now have the ability to illustrate it.
Is that a living benefit? It's in the account, or is that a death benefit?
It's a death benefit, and the living benefit bucket also has that same higher value. So at that point, you have the living benefit bucket, you also have that death benefit. So if you die, you've got preservation of principal, or you have that preservation of principal if you need that living benefit.
I like the idea, because if I'm forced to take RMDs, I usually have to carve into my corpus, my original contribution, my basis.
Right.
Now we're saying, oh, no problem. We're actually 10 years out from now on, we'll be able to replace that. It'll go to your heirs on the death benefit, but they received basically your contribution. You lived off the RMDs, which you were forced to take anyways.
Well, think about it. Banks, we used to do this with bank CDs and some of those other fixed assets, but they're nowhere near enough interest. And despite what we see in the Treasury here happening recently at 2.5%, it's not going to keep going up fast enough. The Fed can't they can't let that happen. Our economy would crash. So there's going to be a tight rein around that fixed interest rate. So right now, because annuities are the only place you can get that interest arbitrage, this is the place to be when you're talking about qualified money.
Well, I like that idea because it gives a flexibility to our seniors. People are always saying, Steve, I really don't need this RMD, or is there any way to leverage it? Oh, I do need my income, but I wish I could do something to pass on to my heirs.
Exactly right.
You're always caught. Listen, these are the kind of things we're talking about. Consumers write us. I answered almost 400 direct consumer questions. 57 of them were about annuities. People want to know about these products. They want guaranteed income they can't outlive. They want to have something that's hotter than just being in a variable contract. This is the kind of thing we're talking about on this show, and you can write us at thebiz.tv for any information. And remember, you can follow me on Twitter, Facebook, LinkedIn, or email me, steve@thebiz.tv. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.